Hey, greetings. Happy Wednesday afternoon. Samantha LaDuc, Craig Shapiro here. So we're going to ask us anything type of format for clients and first and foremost. And then, of course, we do need to talk about debt ceiling since we've had all kinds of other macro event risks pass, whether it be non-farm payrolls, Apple, FOMC last week, and then CPI this morning. And very eager to get Craig's take on both the CPI print, this continued kind of disinflationary trend, but more importantly, any macro event risks on the table as it relates to the X date and all that jazz. So without further ado, why don't you, Craig, just kind of give us a lay of the land, since this is really the number one thing we're looking at next for moving for the rest of May. What's your take? Yeah,
and actually, I'm just gonna as we're talking here, I just wanted to see. I should have done this. There's a you get the Treasury cash at the Fed. We get that number every day, and so we get a real-time look at the depletion in the Treasury general account. And I just want to see, it was expected to be 25 or so billion. That's basically what it was, $26 billion of down again. So what we're talking about here is we're talking about a situation where obviously the government effectively has a checking account at the Fed, and it withdraws money from the Fed when it needs to pay expenses, and it puts money into that checking account when it earns revenues, predominantly taxes, right? So there is a ton of expenses that we pay for, Social Security and defense and everything, and interest on debt. And what we have is a situation where the cash at the Treasury has at the Fed continues to deplete because the deficits are fairly large and growing as tax receipts have underwhelmed. But the plug that we normally would have, the ability to issue further debt, is restricted because we are at this cap, this debt ceiling. This is a self-imposed congressional ceiling that says the government cannot borrow more than a certain dollar amount. This only exists, I believe, in this country and maybe Denmark. Every other country just allows their government to borrow as much money as possible, but the market basically, ultimately dictates how much a government can borrow by changing the rate, right? I mean, if the governments are profligate in spending, rates will go up, currency could depreciate, but there is no self-imposed limit. Here in America, we have this self-imposed limit. And so based on the trajectory of spending that we've been going through and the tax receipts, there is a growing chance that Treasury will actually run out of money in this account in early June, maybe June 7th, June 8th, June 9th, based on the timing of payments and the timing of tax receipts and the timing of some of these bill auctions. So that is risk number one. And you can see that in, if you don't mind, I'll share my screen.
Yep, you got it.
Real quick here.
While you're sharing it, yes.
You can share screen for share. So hopefully you see, there you go. I know maybe it's a little bit hard to see, but you can see here, these are T-bill yields. So basically what we have is the bill that expires tomorrow is yielding 4.45. The one that expires on May 25th is 3.99. The one that expires on June 6th jumps up to 5.36. And the one on June 8th, 5.4, June 13th, 5.39, right? So this is the window here, this June 6th through June 13th, where the bond market is saying, okay, like maybe there's a risk here that we don't get this interest payment because the Treasury has said they're not going to prioritize payments. And so yields are moving higher as folks are selling those securities and saying, I don't want to be in any risk of owning something that might not get paid. Then you can see what happens is the yields actually go down after that for a little bit. And the reason that is because on June 15th, tax payments come in, corporate tax payments come in. So it's like, and then on June 30th, Treasury gets another amount of emergency authorization ability. They're able to stop payments on the Social Security Trust Fund. That frees up more money, right? So that's why the early July dates are not particularly worrisome. Then we start to see yields go up again in August, because that's when the money probably would run out again. So we have this risk here in early June. Treasury runs out of money, but it's like if they can make it happen through June 15th, then they probably buy themselves another 6 to 8 weeks based on these authorizations. So that's kind of the lay of the land. Politically, though, we have Biden, who has passed his version of the budget and saying, the budget and the debt ceiling dynamics should be two totally different things. We always pass a debt ceiling extension. It's gone on for, however many years. Republican Congresses do it, Democrat everybody does it. We don't hold it hostage, and we just pass it. And then if and when we pass it, we will have a negotiation about the budget. Biden has his budget, Republicans have their budget. We should go and do a committee, a conference, and have a real legislative process like we always do. Biden tells, I'm an honorable guy. I've been negotiating for years. Republicans, trust me, I will negotiate, and we will cut some spending, and it'll be okay. And Republicans, the far right part of the Republican wing, are saying, we are going to hold this process up hostage until you agree to kind of very significant spending cuts. This is our only, real power. And we ran on it, and we elected McCarthy as speaker based on this premise that we were going to do this, and we were going to really enact our pound of flesh here. We were going to force Democrats and the Biden administration to stop spending. So, as of yesterday, we had a meeting with Biden and the four big leaders, and McCarthy said no movement, and Biden said, our staffs are talking. There's another meeting scheduled for Friday. So far, really, I would say the markets are not, aside from this T-bill dynamic here, it doesn't really appear to me that markets are particularly concerned about this dynamic.
They had a little intraday when McCarthy spoke today. Again, all the strings attached debt ceiling posturing has been in existence for a few weeks now. But when the headlines come in, it's almost as if an excuse for the algos to sell off.
Yeah, and I think that
immediately defended.
Yeah, look, I think there's, I think those headlines are tied into those computer programs in some way. But look, I think people look back at the 2011 experience, and as we approach this X date, markets really sold off, and bonds rallied a ton, and the gold rallied, and so I think people are just kind of. But ultimately, they got passed, right? Ultimately, there was a resolution, and both Biden and McConnell have said we will not default. So, the market is hearing we will not default. They're saying, okay, then I guess there's going to be some resolution by the time we run out of money, whatever that will be. But it's really too early to tell how this is going to go. They're so far apart legislatively. So
correct. The market doesn't seem to care, for sure, running up the wall of worry as usual. There has been some posturing in hedges for sure into this, not only risk aversion into the 1 month, T-bill, for example, but also very large amount of calls in VIX coming in just in case. So they definitely have some hedges going on. But I was just reading, since World War II, the ceiling has been raised or suspended 102 times. So this isn't our first rodeo. The difference is, if they don't this time, will it force the Fed to do some rate cuts? I'm always curious about that market psychology of, the Fed has said they haven't said actually that they're going to pause. That's my, contention going into the FOMC last week. I think it's good. It's good. 5.25. 500 basis points in a year, and basically historical average 4.6. So I think they're good to just pause here. They've seen what's happened to banks, and they had a 1 year for it to kind of work into the economy. But this also gives them a little bit of room to cut should there be a showdown of sorts. So technical default, we've had that happen a few times. I was also reading about 7 times. So and even Trump shut down for the longest period. So there have been occasions where this has triggered. We've always come out of it. But what is the bigger worry this time? Why does it seem and I don't want to say every time it seems, but why does it seem that this is an outsized risk?
I think it's because politically this country is dysfunctional. And ultimately, the only way anything really ever gets done is in panic or is at deadlines, right? We passed legislation in this country before Christmas break because senators want to go home for the holidays. We passed legislation on the budget on the, the day of or the day before September 30th, because that means if we don't do something, we put the government to shutdown. We will do something on the debt ceiling in and around the X date because markets will panic into that moment, right? So there's nothing in this country gets done unless there's a time deadline or some market panic. And so I think that is why there's probably some burgeoning fear under the hood saying, okay, we've seen this story before. We know ultimately it will get resolved, but we also know that in order to get resolved, we need to instill some panic on the senators and the congressmen and the administration by selling off risk assets. So it's like we're playing footsie, right? I mean, it's like the market's kind of sniffing this out, but S&Ps and NASDAQ keep going higher. So the bond market obviously is very concerned, pricing in kind of significant cuts, actually pricing in, a potential for a June cut, which is what you're making reference to. The Fed has said specifically that it is in no position to bail out the country, the markets, if we default. And I think there is a view and this may or may not be political, but that we should have, in DC, that they don't need to do anything, and that ultimately unelected leaders like the Fed will always just kind of bail them out, or if they don't do anything, then the president will do some sort of executive action. And so Congress really kind of never does anything. But in this instance, there is, really not much that the Fed can do without congressional approval. So
that's what I wanted to ask.
That's kind of where we are.
But isn't just Fed unable to move dramatically without congressional approval, but also Biden floating the 14th article, Vegas odds of that are very, very slim. But this is the question. What about they come together and say, yeah, suspend the debt ceiling, Article 14. What are the chances?
Look, I think ultimately, if we get to June 8th, which is the day that we're close to, maybe potentially have no money.
1 month away.
1 month away. So probably on June 1st, because Dylan has kind of flagged June 1st. But a week before that, maybe we will start to hear about, my sense is we'll start to hear about prioritization of payments. My sense is that Treasury will pay the interest. They will maybe shut the government. They'll stop paying salaries. They'll close the national parks. They'll do what it takes to make sure we don't ultimately default. Even though Yellen has said prioritization of payments is not on the table, that would be a technical default. Well, if she I guess we could envision a scenario where she ultimately makes the interest payment that's due on June 8th or June 9th or whatever day that payment is due. And somebody, and people say that's prioritization at a technical default. And they're like, no, it's not. We'll take it to the court. And then ultimately the court, whatever courts decide, they won't decide for a week. And by that time, the Treasury will have gotten more money in from these tax payments, right? Because on June 15th, corporates are paying taxes. So I don't really know. My sense is we're not going to, I think if we default and we miss a debt payment, like shit's really going to hit the fan. I mean, and I don't sense that anybody really wants that to happen. So I think they're more, as far as the 14th Amendment is concerned,
more posturing.
Basically it says, we cannot default, so we're not going to default.
So
right?
that's the interesting thing. Back in 2011, Ben Davis had written about this in Twitter, and you and I were both tagged in his tweet, in his thread, but he said post 2011, also before the downgrade, right, in 2000, I forget when Fitch did the US downgrade. Anyway, they had a political convention was basically, we're going to suspend versus raise. And then when I saw that, this morning with Biden, don't worry about it. We got our Article 14. I'm like, yeah, we will. That's never been helpful in the past. At the same time, two very large Japanese insurance companies said that they will start to sell U.S. Treasuries. So is this, again, timing, it's not causation, but definitely correlation in regards to U.S. Treasuries and money going home, in this particular case, Japan. But it was just interesting, the timing of both of those headlines coming out on this, the same date that the market intraday is absolutely starting to move very chaotically, intraday on algo-driven headlines like McCarthy coming out and again emphasizing this is a strings attached, we're not going to budge, et cetera, et cetera. So I'm just like, your sense is one thing, but then the absolute tail risk is another, of firms having to protect, like they're being forced to protect. They're buying SPX calls. In fact, we have more calls to puts in SPX similar to January 2022. I was talking about that in the live trading room this morning. At the same time, we have massive VIX calls as tail risk all the way out to September, with some very large positioning in September, just in case this gets kicked down the road. And the last time, 2011, they raised 2 days before the X date. So there's, a little history repeats kind of thing, or rhymes. But we had already fallen, we're halfway through falling 20% from peak to trough, just during that drama that they weren't getting their act together to deal with the debt ceiling smoothly. So markets started to sell off, before the Fitch downgrade. But this is just the only fractal that I'm looking at now in regards to the prior occurrence in 2011.
Yeah, look, there's multiple timelines here. And I think, first we're dealing with the debt ceiling issue, which, again, is very political. And, there's, if in the worst case scenario, it's really, really bad, right? And like the 5% scenario that we actually default, creates, chaos. That's, I don't know if it's unimaginable, but you basically have a defaulted reserve currency. Like, various entities cannot own securities of defaulted countries. Like, that 5% scenario is a very, very averse scenario. So, and, I think cooler heads will probably prevail, but is it going to be a situation where it's just, we kick the can for a week, a month, 2 months, and are we going to keep dealing with this kind of every few weeks? After this, and maybe commensurate with it, is the budget discussion. So we do, by September 30th, need to fund the government for the next year. So that is something that does need to get done. And what's been happening so far this year, and there was another data point today, the budget surplus in April was very, very low versus expectations.
Oh yeah, tax receipts.
Tax receipts were down 26% year over year. Now, part of that is because California didn't have to pay until October, but still, there was an expectation of a $230 billion surplus. It came in at 176 billion. We've been talking about this for weeks. Budget deficit in March was negative, was 380 billion. So 6-month annualized, budget deficits are over $1 trillion. If you're in a situation where growth does slow, tax receipts come in, even without spending cuts coming from whatever budget negotiation, once the debt ceiling is passed, Treasury needs to raise a lot of money, right? They need to borrow a lot of debt. And so Yellen's going to, and particularly if this is a short-term debt ceiling, Yellen's going to look to refill the TGA, her checking account, as much as she can, as quickly as she can, so that she could deal with this situation in the future if need be. And the growing deficit means that we are going to need to raise more debt to plug the hole. And so the question then becomes, if we're raising more debt at these higher interest rates, that's puts further pressure on the budget, right? Borrowing money at 5%, versus 3% is an incremental cost to the treasury. That's higher expenses, that's higher budget deficit. Who is going to buy all that debt? And when you have a situation like Japanese life insurance companies saying the FX hedged yield of buying US treasuries is about as negative as it's ever been, we're not going to do it, or we're going to do a lot less of it. Okay, that's one less buyer. Then you know that other countries are buying less treasuries. China's buying less. There's increased trade away from US dollars, right? The foreign demand for these bonds is going down. Who is going to buy the debt?
Forcing them on, or so to speak, banks, and banks are in no position to take on more.
Right. So that's where I'm starting to see a big risk kind of further out, is this balance of payments issue developing in the US that historically has not been a problem because we are the reserve currency and we can just print money. But we are in a situation now where that concept is being put under pressure as more trade is being done away from US dollars, as central banks are buying less FX, buying less treasuries as reserves. They're buying more gold as reserves. This trend is happening. And yes, it happens at a glacial pace, but once it gets going, it's more like a snowball going downhill, right? I mean, it starts slow, but we're moving more rapidly.
But the interesting, heads we win, heads we lose, tails we lose scenario, where if the debt ceiling is raised, Congress is still going to be forced to cut spending or raise taxes, either way. So there's not, that's equity pressure, if you will, or headwind. But the other thing, I am still curious, your take on this. I still see the 10-year falling, right? So we haven't
yields. You see yields falling. Yes,
the 10-year yield. Yeah. Falling. So this kind of this range bound motion of 3.876 and 3.33. So we just cannot get above or below, and that's an inflationary impulse above and a deflationary or disinflation, however you want to call it, below. But the point is, we've been absolutely range bound. Back in 2011, when they did this dance last, similarly, the similar dance. We lost 100 basis points in the 10-year.
Yeah.
So right away, like that, it just goes right over with equities. So now we've got this convergence, right, where it's NASDAQ is positively correlated with yields. So I'm looking at that as a potential trigger for yields breaking my 3.33 with gusto and following through, right? We've had a little bit of dip above and then back in below, back in the channel below, back in the channel. But this would be much more definitive as far as breaking below my 10-year yield 3.33. And like I said, 2011, they dropped 100 basis points. What's your view on not only the yields, given the difficulty in the bond stuffing, right, that you're talking about, but also the dollar? Those two in particular, the big macro movers of all things equities for the next month are dollar and yields. Where do they go?
Yeah, look, I think people are looking back at the 2011 playbook and saying that in either instance, I want to own duration for now, because I want to own the 10-year. 10-year yields lower, because either, we're going to default and it's going to be, really, really bad for everything, in which case, like, I want to own fixed income, although you're owning fixed income of the defaulted US Treasury. It's a little bit bizarre, but I guess folks assume that, it'll still be, even if it's a small technical default, it won't really matter. Or it will be solved, but there will be damage done to the economy from this saga, which is risk off, which is a reason to buy duration. Or Republicans will prevail and they will, force some spending, force some tax cuts, but Biden will move to reduce the deficit, which would be bad for growth and good for bonds. So I think people are in that, there's some expectation of that, going on right now. So look, there was an auction today, 3.45% for 10 years. Like, I can't for the life of me want to invest my money in a 10-year Treasury for the US earning 3.45%. And I think people are buying it because they think it's going to go to 3.2, right? Or they think it's going to go to 3. And I'm just like, they're buying it to trade it. They're not, this is like, so I could see that scenario where like that kind of risk off environment takes yields lower. But ultimately, I think whatever the resolution of this is an incredible steepener. I think this is long end yields up materially as folks realize that the US government's cost of borrowing is higher. As they come to market and they try to fund and they try to restock the TGA. Right now they're doing, they're funding themselves with bills at 5% plus. The Fed is not cutting rates and will not be asked to cut rates until inflation comes down and unemployment starts to go up, neither of which is really, happening at a speed that is commensurate with rate cuts.
This would trigger it, even if it's technically trigger it, it would definitely reverse the low unemployment, even if temporarily. So, and a lot of models run off of that employment level.
Yeah,
so,
I think the Fed is reluctant to be seen as acting specifically to lower the borrowing costs of the US government. Powell has said that would be like fiscal dominance, and that basically the Fed is no longer independent. It's being forced to lower rates to fund the government. And he has said, and I think it makes sense, that the Fed should not be in the business of doing that. The Fed should be in the business of maximum employment and price stability. And so, yes, it is likely that in this environment of high interest rates that we will see that kind of unemployment and we will see most likely inflation come down. But the Fed needs to see that in order to cut rates, not do it in advance of that. I mean, like right now, the market is pricing in, nearly 3 cuts for this year. September, basically the September, I forget if they have late October, November and December meetings. So that's what's being priced in right now. The Fed has said that the current unemployment rate at 3.4 could go as high as 4.5, which is their dot, and they still would not be cutting this year. Okay, so in order to get from 3.4% unemployment to 4.5% unemployment by December, we would have to lose close to 1 million jobs in the next 4 months, right?
Yeah, that's their model.
It's just not practical. It's just not in the data.
Unless we have that ceiling, then that's a real fast way to get there. But
so I guess my point is there's an inconsistency. There's an inconsistency being priced in.
What about the dollar? I think this would be a temporary dollar strength move, but at the same time, I have 98 Dixie, on my radar as a Q2 level. So, I'm trying to unpack that as well. What's dollar movement? I mean, we saw it today a little bit, right, with the CPI, and then it completely reverted again. So we don't really have a lot of energy to move dollar higher. In fact, the path of least resistance is lower, but this is a trigger. So what temporary US strength would be my call if we have this type of trigger, but big picture, I still don't see this getting up and out of a way, up and away.
Yeah, look, I think the dollar week trade is fairly consensus. I think people are positioned for that. And so I agree that some risk off that comes in around this debt ceiling is probably more dollar bullish, specifically versus risk currencies like commodity currencies, like EMFX currencies against on the Dixie, specifically against the euro and the yen. I mean, probably it probably gets stronger, but I don't think it materially gets stronger. I think it will devalue against gold. I think gold would have another run. I think if you look back, and I'm looking back to, it's hard to look back at 2011 for the Dixie move, because during that period of time, we had the Greece crisis. So Europe was having its own issues. So the dollar kind of was weak into its debt ceiling and then rallied materially in September, October, November after that because of the European crisis. Yeah. So it's not exactly apples to apples, but yeah, I think I would agree. Short-term pop, but then structurally, probably still remained under pressure.
And the euro dollar trade higher with pound sterling has also, risen, but as China came back online and that whole kind of growth and inflation proxy into Europe. So, which I don't know, do you see that petering out anytime soon? Because there's a lot of debate around, the China credit impulse and the liquidity models and such, but I just really look at the news as it relates to where they're incentivizing. And in October, it was very clear that they were incentivizing banks, ordering banks to buy stocks. Now they are telling the big four to lower their deposit interest ceiling. So is that to kind of, I surmise anyway, that trying to get some of that cash that's sitting there, they're good savers over there, and be more productive and get into the economy and stimulate. But right now they're trying means to get the stimulation into their to cause that growth impulse.
Yeah.
Any comments on that? Because the dollar yuan matters, right? The
I just put that
currency matters.
This is a dollar RMB chart right here. I mean, dollar's been kind of, this is the China's going to reopen. China's going to reopen. It's great for the RMB, and then China has reopened, and all of a sudden, like, the dollar is starting to grind back higher again. I think what we're learning, and it came out with some of the trade data earlier this week, is that the recovery in China, not surprisingly, is not as robust as everybody expected.
Domestically, it's been good for them. It's just not been exported.
Yeah, and look, I think it's been fine. It's just, the expectations were very high. I mean, this is copper, right? I mean, copper is now, I don't know. This doesn't look like a particularly great chart. It's trading below the 150-day. It looks bad, and so copper, that kind of signals to me the recovery, in China is kind of under some more pressure. This is iron ore. It's been kind of pretty crappy here. So
we've done a great set of reflation trades short, right? The XME and the XLE and the XLF on this. China's not going to grow as much as expected, and oil demand is not going to grow as much as expected, even with supply cuts by OPEC plus. And the copper chart is kind of saying the same thing. But where to from here? I mean, we kind of talked about the debt ceiling being the biggest macro event risk for the next month. Maybe it's dollar supportive, and yield suppressing even more. Equities don't seem to care. They are very much, rising up, and a lot of bottom fishing, plays are as well, biotech, et cetera. This is seemingly this, I don't want to call it the wall of worry, because that's just a sentiment tell. But so far, we do not have volatility. We have closed pretty much within a few dollars, at the end of the week for the past 4 weeks. Like, we've gone nowhere fast. So there's definitely a kind of a paid to wait. We know money's off sides and earning 5%, but there's also this lack of movement in indices as a core tell, as they're waiting for something to happen. But nonetheless, what is your prediction as if we would get volatility coming into this May timeframe? I thought it'd be coming in mid-May. So like just from tracking, I'm like trying to, but every day it gets whacked back down. So I still don't have even the credit, the HY, OAS that I always take a look at. It's intonating, but it's not following through. So what would be the headline or the trigger that you're looking for that would really create some volatility in equities?
Yeah. Look, I mean, basically, and this is a chart of, NASDAQ versus IWM. I mean, you could see just, this is obviously structural outperformance for a long time, but this, with the regional banking crisis, like how much NASDAQ's outperformed and kind of getting this ratio back close to the highs. I mean, it looks like, I don't know, it looks like to me it's gonna make new highs. But and I think in a way it does make sense, because if you're concerned about growth, underlying cyclical growth momentum, because let's say China has underwhelmed, let's say the US tightening cycle is starting to, bite further into credit markets and into regional banks and into autos, and it's going to keep going. And now you have this government shutdown nonsense issue. Where do you want to put your equity capital? And you sprinkle on the AI theme, right? I mean, and so you're just getting the flows into big cap NASDAQ, right? It's really a force that is hard to wrestle with, right? I mean, Google, said AI today, and the stock, rallied intraday 4%. I mean, you just say AI and the algo picks it up. So it's hard to stop that momentum. But we've seen this time and again into expiries in the second month of the quarter. Various Februaries have come to mind, and May's come to mind, and August's come to mind, where we have these kind of blow-offs into those expiries, and then we start to kind of, we start to roll after that. And so, as far as a headline is concerned, outside of the debt ceiling, I'm not really, which I think is, obviously top of mind and will be headline driven. As far as the data is concerned, there's really not much that I think can necessarily move things. But, as far as, Powell speaks next week. So we know that he speaks on the 19th. He's speaking on a panel with Bernanke.
Interesting.
Yeah. Tomorrow, Kashkari and Waller speak, Bullard. And so not that the Fed governors are the be all end all, but as far as what I think the biggest risk to the markets remains is that the market is pricing in a very aggressive rate cutting cycle. And so to the extent that the Fed pushes back against that narrative in some regard, let's say they say, yes, today's CPI was nice, but core CPI is still 5% plus, and next month is expected to be 5% plus. And so, we're not, we don't anticipate cutting rates this year. They're going to keep maybe harping on that. It's possible that you can get one of these guys to, say that June is a live option, even though Nick Timiraos today said June is off the table, right?
I don't think there's going to be any cut this year. I think they're just going to hold that pause. You already, I forget which chart you showed, 2006. Where they
held it for 15 months, 13 months, but yeah.
And at some point in the early 1990s or something, they held for 5 years. I just don't see any motivation for them to continue raising or cutting. I think they just are done, but they don't want to announce it because also the psychology of markets, right? Sell the last hike.
Yeah, look, I think we are going to get to that point, right? And I think maybe it's the minutes that happen in a couple of weeks, or maybe it's Powell next week. And I think you're right. I think once we get to the Fed is done raising, then look, the market has kind of traded that the bullishness that comes from the fall in rate vol, that comes from the Fed stopping. So we've kind of, this is the front run. This is why S&Ps are closer to 4,200 than they are to 3,800. So at the point when people actually realize that the Fed is done, then they will go back into history and say, okay, now what do we do? And I think we talked about this last week or the week before, that the 6 or 7 prior episodes of what you do, what happens after the last rate hike. In inflationary environments, the market is down, and in deflationary environments, the market is up. And I think that has a lot to do with, because it's the timing to the Fed's pivot. So we are in an inflationary environment. That means the timeline to true pivot and cutting is longer, which is why the market is likely to fall after the last rate hike. So I think we will transition to that period. And as folks start to realize that, yes, inflation is falling, but the Fed is not going to do anything about it to stop the growth momentum declining. They're not cutting rates anytime soon. Then the market will complain about that by going lower, trading risk off, and the like. So we should start to learn that, I think, over the course of the next couple of weeks, and probably Powell speaking next week, or a Fed minutes has the potential to kind of articulate that. But as far as very short term, outside the debt ceiling, if they just keep selling vol, we are going to have, the possibility of a further melt up in NASDAQ is very possible, particularly into next Friday expiry, with the theta decay and the Vanna and the charm and all the other cool Greeks, from the options now, and so maybe it's all we need is to see that blow off, and that we have it.
It's also the hedges. So, like Apple came in before Apple announced, actually, there was massive call selling at that like 185 area. I forget what month it was, but those large hedges oftentimes act as a magnet. It's fascinating. Don't ask me to explain it right now, but it is definitely something that I see when I see a very, very large hedge come in. We tend to move up into it before that is monetized, and then we fade. So in the scheme of things, it's fascinating how sideways we have gone in the main indices, how strong mega cap tech has stayed, and now under the surface, in the past few weeks, biotech, and I'll call it oversold tech. A lot of people, they like to correct me. They're like, it's not oversold. It's, it's still unprofitable. So it can't get oversold enough. but relative to what's going on in, NASDAQ composite, the NASDAQ 100, there are some, cherry picking plays, whether they come up out of the grave. We saw Pelletier and Upstart, and we're having some outsized moves, and likewise, misses have been pummeled, whether it be Tyson or Twilio. So there's definitely overreaction right now in the market, which is phenomenal for trading, for actual trading. But for investing, there's a lot of apprehension, not wanting to position too aggressively into a debt ceiling kind of standoff. So for folks that are in like portfolios, right? So, obviously trend trades aren't gonna, I'm not going to care about a CPI or even an FOMC. It doesn't motivate me to do anything differently. Earnings are definitely motivating, but as it relates to trend trades in a portfolio, how are you suggesting for clients, and how are portfolio managers actually really getting their arms around the potential risk, or are they just saying, nope, they're going to come up with a solution, business as usual, market's going higher, we're just going to go with the flow?
What I normally find in this type of environment, where there is a pretty strong kind of relative relative momentum trade, in that there's, big tech has an AI undertone that is kind of top of mind, and regional banks are clearly struggling, that you will get folks to just press that pair really until it breaks. And so, because there's not really going to be a fundamental reason why that trend breaks. So I think you're going to continue to see tech outperformance on a relative basis. I think you'll see IWMs underperform. I think you'll see regional banks underperform. And I think guys will just keep those trades on until the momentum just kind of stops. Now, the momentum could stop at an expiry. It often does, but typically, it would run into the end of the quarter, because people want to show that they own NVIDIA and Apple in the second quarter. So this could 100%. run for a few weeks, and it's not clear. NASDAQ is, its relative outperformance has been great, but it doesn't scream to me like, if you look back on standard deviation basis, on my screens, it's not in the 99th percentile we're bought yet. It's so there's still momentum there. So I suspect that's what we're going to keep seeing, is this NASDAQ outperformance. Now,
I still see that SPX gap fill, and then I'm perfectly fine. Like it's done. Like, in other words, the Qs have filled that weekly gap down, Apple and Microsoft, oh my, but we have not tagged that roughly 4220 area. So I still can see this consolidation for the past month, literally. I was hoping we get a little bit more volatility mid-May and then just finish it, like just go tag it and be done. But it's very unsatisfying. We haven't hit it yet.
Yeah.
But I'm definitely curiously in my big picture intermarket stuff, I swear there has been no change. So no change from the fact that this is still a bear market rally under the surface, at least from my intermarket. Obviously, the concentration risk in tech, like you just said, And then, long tech, short reflation trades, because literally metals and mining, even XLE's in solid distribution now, after banks have kind of served their purpose, right? They were a short into the bank crisis, and now banks are just kind of sitting there, and really just there's
Right.
not a lot of advantage higher.
I think what we're learning in this bizarre, I'm kind of thinking on the fly here, but what we're learning is that in a zero rate environment, you want to own, these duration assets. You want to own big tech, you want to own speculative tech, whatever. But it turns out that even in a 5% interest rate environment, you may still want to own big tech. You don't want to own unprofitable tech. You don't want to own stuff that doesn't have access to capital. But these companies that have massive cash hoards,
yes,
and they actually look. I mean, Apple itself, it just did another bond deal. They're buying back shares. I mean, they could put excess cash into basically the RRP or some element of a mutual fund, money market fund. They're earning close to 5% on their cash, right? So
they did a big bond.
They just did a big bond deal. They're borrowing money, 30-year money at 4.5%. I mean, so there's ARB there for these big tech companies, and I think that's what we're learning is that they're still the place to go, whereas more cyclical areas of the economy cannot function at this new 5% cost of capital.
This is, I think, the kernel of the corn. So, for example, when the market does turn down again, we'll smell it underneath, with the selling and the distribution and breadth, et cetera, et cetera. The low-hanging fruit will not be the cash-rich, asset-rich companies. No, it's the ones that are not going to survive or thrive in a 5% environment. So where the bifurcation for me is right now, there's this overemphasis in selling the reflation trades, the banks, and bidding up tech. We still do have loose monetary policy, even if we have, 500 basis points higher. There's no question they still have flooded with liquidity, even if it's waning. But no question that whole mentality of we're going to go find the biggest, safest companies, that's not risk on, that's risk aversion. That's just Bank of Apple. And it's a value play with lots and lots of cash. It's not going to go away. And then for me, that's not really, if that's all we had to do, I would have nothing to do. I want to find what is going to rotate for the most volatility, and obviously shorting Apple, even on a reversal, is just not so satisfying because it's not going to go down very much.
I had this other thought too about big tech, which I'm trying to kind of explore. But I mean, and I kind of tongue in cheek said Apple's borrowing 30-year money at 4.5%, and Treasury's borrowing 1 month money at 5.8%. Like, who's a better credit, right? Apple can borrow. Now, yes, the U.S. government can borrow 30-year money at 3.5% somehow right now, but Janet's not selling it there. But there is an argument to be made that Apple is now a better credit and is a better place to put money than the U.S. government. I know it sounds crazy, but if you really think about, how government works and how dysfunctional government is, Apple can generate, free cash flow to pay dividends and to buy back stock at a faster rate than the government can tax it, right? Because there is no momentum. In order to stop the tech story structurally, we would need to tax tech companies much higher, because they're the ones who are embracing AI. They're the ones that are displacing labor all around the world. And so U.S. government's going to eventually have to deal with that. So we got to go and tax the big tech companies now so they could, help fund the government. Or two, a regulatory regime shift that puts a dent into AI's momentum or something. Or antitrust. Okay. So what moves faster? AI and Moore's law and government's and Apple's ability to generate cash, or the government's ability to regulate and the government's ability to tax? It's the former. Apple can. So 100%. I'm not saying this happens forever. At some point, government will figure out a way to tax these guys and slow them down and to regulate them. But right now, given the dysfunction in DC, I don't really see that as something that anybody is really focused on. So, I mean, I could see why you would just keep your money with Apple as opposed to giving it to the US government.
Except the valuations are getting ridiculous right now. So, I mean, they're still being bid up, NVIDIA, Apple, and the rest, to unruly levels of valuation. So,
well, you could buy them. So you could buy Apple. I mean, if you wanted to buy Apple bonds or whatever, I could see, I think even in that Japan insurance company story, they talked about maybe shifting money out of treasuries, into corporate debt, right? So, I suspect that's investment grade, that's Apple stuff. So, yeah, look, it's still a stock, it's still got crazy valuation.
But there is a very good argument right there underlining what you just said, money going home, meaning as Japan starts to shift and create an environment more for investment at home, there will be a situation where, some of that, this is the Druckenmiller, dollar short theme, right? One of the concepts is that money's going home. It's leaving the U.S. equity market, U.S. Market for greener pastures. We've had our green pastures. It's going to go find new land, and it's going to be right back home. So that hasn't really started a trend,
yeah.
But that's definitely putting pressure on the dollar, potentially even more so, and that is harmful to U.S. equities, and in particular the largest traded mega cap tech.
So look, I think I think the largest thing, just kind of thinking about catalysts, right? Ironically, once the debt ceiling is solved, I believe that is the sell that could potentially be the sell the news moment.
Yeah.
But the reaction of a debt ceiling, depending on how things work out, right? If we're down into the debt ceiling, because everyone's worried about it, then it will be a pop, and then I think it's a fade, right? But if we never sell off on the debt ceiling, ultimately I think it could be that moment where the long end of the bond market finally, basically puts a bottom in. The yield or puts a top in. And yields have at that point, yields will have
long
bottom.
end? Like
10 years, 10-year, 30-year.
Okay. I like a 30-year. That's,
Yeah. So I mean, look,
bond.
I think, look, I think 30-year yields after the debt ceiling is done. I think 30-year yields are going to go to, 5% plus. Because folks will start to realize, that will be the moment when folks actually start to realize, holy shit, the amount of debt that the government is about to raise is enormous. Because they're going to restock the TGA, 500 to 700 billion, and we're running 1.5 to $2 trillion deficits. And in a recession, if that's what we have, we typically will jack up, the deficit spending by 5 to 8%. So that would be another, trillion plus, right? So we're talking about potential for massive treasury supply hitting the market. And is that treasury supply going to be financed at 3.5% 10-year or something much higher than that? My sense is it's going to be higher than that. When I hear Japanese life insurance companies are pulling out, when I think about central banks buying more gold, when I think about trade moving away from dollar, I think, well, the foreigners are not going to come up and buy this paper, and banks are going to be forced to buy the paper and don't really have as much balance sheet capacity maybe than they used to. So the cost of capital for the U.S. government is going up.
Yeah.
And so if that leaves the back end higher and yields really move higher, that could be the element that then says, okay, that pops the tech bubble, that pops the emerging market bubble for real, because then the dollar, then we really start getting dollar shortage and some of those.
What's your
those
trigger
issues.
for that, for either the 10 or 30?
What's a quantitative trigger
quantitative trigger.
I know
that's not your jam, but still,
I'd start selling 30 years at 3.5% for sure. I'm over 380 now. I mean, it's been hard to break under 3.5% for, since last August. So I don't know, it feels like a decent, I think, selling into that, I think makes a lot of sense.
So what's coming up otherwise, we've got inflation. We know it's sticky, it's elevated, what have you. We don't need to really parse the details of CPI because the big point is it's not really market moving. FOMC is definitely a June event. And then we have NFP. Forgive me, is it right before or after FOMC in June?
It's before. It's June 2nd.
Okay,
it's early.
Okay, so it's early.
Yeah.
Much more important than the CPI that follows, in my humble opinion. But nonetheless, we've got NFP, then FOMC, and then CPI, correct?
Yeah, I mean, between now and then, you know,
and what's the X date?
Yeah, looking at the looking at the calendar. Let me just share this just because
okay. And the X date. Those are the only things that I have in mind. Otherwise, it's kind of like business as usual. Wall of worry, 4220 SPX.
Yep. Okay, so that didn't make it bigger.
I cannot read any of that.
Yeah, I'm sorry. I know it's because that's always the
compressed.
Can't see it still. Hold on.
No. You just okay.
All right. Well, we just had I just went real loud. We just had the CPI, but tomorrow is PPI. You know, Friday is UMISH, and since oil has been neither here nor there, I don't expect this to do much. I mean, look, if this popped up more, well above 3%, maybe that'd be something. And then next week is retail sales. Then we start to get into these regional PMIs, and then the Fed minutes are on May 24th, and PCE is later May 26th, and then here we go, beginning of June. And as far as the Fed is concerned, like I mentioned earlier, you have some speakers: Waller tomorrow, Kashkari tomorrow, Bullard and Jefferson, and then here's Powell on the 19th. So. And then the
19th matters, the 24th matters, and then we got to wait until June 2nd.
I think that's right. And as far as the X date is concerned, look, we get the Fed's balance sheet every Thursday. We get the Treasury General Account reading every day. So we can monitor and watch. And it looks like from some estimates that I'm seeing, June 8th, 9th is the low point for cash. So that is the dates that we kind of need to target on. Yellen has specifically said we may run out by June 1st. I think that is a little bit of posturing, but I mean, between June 1st and June 9th, there's really not a lot of time. So I think even by June 1st, if they thought they might run out on June 9th, then we would have their Treasury would be doing something about it. So I think that's our window to be thinking about, but every day we get an update. And so if it looks like we're drawing down more aggressively than forecast, like we did today, the forecast I had seen were 25, 26 billion, came in 30. So that's 4 billion above. Every billion counts, right? We're literally going to be at, 10 to 20 billion dollars of cash left. And so, it's pretty close. Every billion matters. So June 7th, 8th, 9th period is kind of the target.
All right. So then that's it. I mean, we really just don't have that much else in regards to macro.
It is. I mean, I was going to say we'll get these these weekly claim numbers and the labor stuff, and that only will start to either confirm the market suspicion that job cuts are coming, or it will, push back this idea that a lot of job cuts are coming. We'll have to monitor that too. But it is an eerily quiet.
It is. Period. Oh my God! It feels like August. I swear to God, I've said this so many times. The action in the indices is just like Crazy Ivan August trading, where really they're just on vacation and they're keeping it stitched together. Before we have a more momentous move back when everyone comes back, in September. It just feels like that. But there's still lots of action underneath the surface. So no question, I'm still seeing that sector rotation, it hasn't reversed yet with, down reflation, up mega cap tech, and then obviously lots and lots of earnings getting chased. But ultimately, as it relates to macro, dollar matters. For sure, gold has been shining and does not look at all done, even though we both expected a little bit of pullback, got nothing. What about the dollar yen and your baseline bet for June FOMC? Do you think they pause, hike? And I know if we have an event, they would cut. But my point is, do you think that they hike or pause? They got to do one or the other. They can't just say we're not going to make a decision. I mean, there has to be, a result from their meeting. So what do you think is going to happen in FOMC? And then of course, dollar yen, it's very quiet over there too.
Yeah, look, I mean, just kind of put
Can you hear the ice cream truck behind? Isn't that sweet?
No.
Suburbia.
Nice. Hold on. I mean, this is let's see if it came out. I know it's again going to be not so easy to read, but I'm going to make it a little bit bigger. Can you see that? Well,
okay, keep going.
So the market is pricing in basically nothing, right, for June, I mean, and at this point, I suspect that's correct. I suspect that the Fed will say that it is done raising rates, and it'll say it's kind of in wait and see mode. I don't really suspect that there'll be a data point that we learn between now and then that will kind of get them off that. Although look, I think if there is a very, very robust payroll report, maybe they would move, but we won't know. We won't get any real clarity on that for 3 weeks. And so
we're totally not expecting anything blowout though.
Yeah, exactly. And
in fact, revisions have been negative, but that's
right.
Of course not the market reaction. They don't care about revisions.
Right. And that data point is going to come out in 3 weeks. So I don't think the market's going to trade very aggressively for a hike between now and then. And oil prices remain kind of under, so yeah, so they're not really going to see an acceleration of headline inflation. So we're expecting, a drop in headline inflation down to like the low 4%, because that's just year-on-year comp stuff.
Yeah.
Core will still be mid fives, but headline will come in. I think Cleveland Fed's looking for 4.2 or something, pretty low. So with that kind of reading into the Fed meeting, I think they'll be comfortable saying, okay, we've done a lot. It looks like we have some momentum. Now we're on pause. And the question is, how do they message that pause really means pause and not imminent cut, which is what the market is pricing, nearly 40% chance of a cut in July and a full cut in September, another one in November, and then another one in December.
Is that based on inflation, this disinflation impulse that we still have from December, or is that just because they're pricing in recession? Again,
I mean, Powell said that it was his belief that the market has a much more sanguine view about inflation than the Fed does, and that the market believes inflation will come down much more rapidly than the Fed does. And so if the market was correct that inflation came down that fast, then potentially the Fed, would be cutting. But Williams yesterday said he doesn't see any reason to cut this year. So there is, again, a disconnect. So I think part of what this 3 cuts is pricing is some element of, imminent hard landing, maybe the risk of an imminent hard landing that comes around with a debt ceiling or a government shutdown that maybe forces the Fed to, do something, right? And so if you thought, like if the Fed was very worried, let's say if shit really hit the fan with the debt ceiling and the Fed had to do something, I think it's fair to say they wouldn't just cut 25 basis points, right? Like they would cut 100. They would do a big cut.
If we had real drama.
If we had real drama. So part of what's being priced in here is shit hitting the fan. And that they have to cut 100 in one fell swoop, right? That it's something happened, we defaulted, or there was, I don't even know, some catastrophe, and the Fed had to do an emergency meeting and cut 100 basis points to, basically save the market. And so part of this is pricing in that potential. But I don't, it's without the debt ceiling, I don't really see this reality happening. It's just hard to see.
I still do have that credit impulse that still is well positioned to move higher, but hasn't. So I can't help but wonder, well, what's under the bush.
Yeah.
But for right now,
I think it's just going to play out. I think it's just going to play out longer than people think. I think it's going to take a little bit more time to see the claims spike and, and layoffs happen in a large way.
Well,
And so
if
I
we
think
have a debt ceiling breakdown, in getting it done, getting it pushed out, then we would have that exact spike in unemployment.
That's
and
true.
layoffs. So that
That's
would be
true.
the trigger.
Yeah,
But I
no,
can't-
no, for sure.
But
For
it's funny,
sure.
I still can't get over the fact that I'm still with it, and I've shown this, right? All this high yield, which is not the level of it's the pattern. So the pattern is still staying elevated in this 5 area, which was the bank crisis highs. It has not come back down. So there's something still, and the move index is still, elevated. So there's still there's a skittish market in both credit and bond volatility that has not abated, period, end of point. They're still expecting some other shoe to drop, whether bank crisis, whether, Putin, whether debt ceiling, but there's no question that it is not calm as it relates to default risk, credit risk, interest rate risk. So those things are still, in one kind of side of the house, and then the other, they're having a party in equities. So
yeah. Look, I mean, I think that
parents are sleeping.
we've seen this, we see this time and time again, and these relationships can get very, very stretched. We'll monitor the degree of overbought and oversold and try to kind of catch inflections. But I agree with that. The most imminent catalyst right now for something is, however the debt ceiling plays out. It's not, it doesn't seem like there's any issue brewing in Europe. Rate hikes need to go on longer there. Seems like Japan is not going to imminently change policy, so I don't expect anything there. As far as China is concerned, I think China is seeing slower growth than expected, and I don't anticipate stimulus yet, but I don't really view that as some sort of systemic thing. Other emerging markets, it just seems kind of quiet. It seems kind of eerily quiet.
How about Japan? Because it's been also new chief. And it has been quiet, but they are also intonating normalization of policy in June. So this is another thing where this could pop up, their yield curve control, and be destabilizing to markets. And they did this, yen intervention September 22nd. They didn't talk about it. They didn't clear it with Yellen. And then, gilts imploded. So at the exact same day, the whole thing was all very sus. But the point is, they have been very quiet, and that's fine by equity markets until they're not.
Yeah, I mean, I think I said this. I said this last time, but I don't suspect that they are going to do something material until the U.S. situation is figured out. I mean, you have these G7 meetings going on right now. Yellen flew there, I think, last night or today. That's going there tomorrow, and I think there's discussions about what's happening, right? I'm sure she has to defend kind of what is going on here.
Yep.
And, I at minimum, she's probably telling everybody, please, don't do anything to screw up the situation for us. And so I think, Japan would probably stay on the back burner until something here in the US is solved.
Well, we'll see. We still have financial conditions still very, very tight. Bank lending standards remaining tight. So that has not gotten solved. But all right, I'm not sure there really is. Oh, we talked about Japan. What about your baseline bet though for June? You said pause. You agree, or you
for the Fed? Yeah.
Okay, I'm getting that. All right. I don't know if there are any questions. We covered dollar, yen, Japan, equities. We're looking for the inflection points. We're looking for the rotations. We're looking for the selling. We're looking for the breadth. You've got your macro event risk that you're monitoring, and the TGA and the bill activity daily. And I'm looking at the equity net buying and selling and distribution under the surface. So it's lots and lots of chases and swings, and nothing has right now upset the apple cart. However, I still have lots and lots of the same, like
Yeah.
nothing, because we haven't moved in the indices. It makes it very tough for the intermarket to also identify any inflection points, because it's literally just holding.
Right.
So
No, look, I think the
I don't have
strategy.
anything smart to say.
Yeah, I think the strategy is, continue to own breakouts and the chases and stocks with, that have having that strong momentum but keep your head, but keep an eye on these dates and keep an eye on these macro catalysts and, have insurance on, because, there are situations and scenarios that could play out, which could be very damaging on a very short-term, perspective, and could lead to much more economic damage, right? I think part of the 2011 story was that the debt ceiling happened, markets sold off a lot, but the real economy kind of didn't really struggle too much. There was, they reintroduced QE2 or whatever it was. There is a scenario where there is real damage that gets done by this debt ceiling, and the Fed is slow to react, and it becomes real damage to the economy. And so that would be, something that we need to be hedged for and continue to monitor. So,
and there was a hedge that came in this week, which was interesting and telling. It was a $5 million financed call spread in VIX. Like, I don't remember the exact put they were selling, but like the 20, and then buying the 40 by 60 call spread. Anyway, the point is, if that was to trigger, if that was to hit by September, it would be 10 times. So there's, and I've definitely been monitoring the calls are outnumbering puts at a level we had in January of 2022. So they're still buying the equities market with volatility and of rates, dollar, absolutely, and credit, staying elevated. At the same time, they're hand over fist buying VIX calls in the event of some type of debt ceiling. I don't want to call it default, but trouble. So we'll just call it trouble. All right. So I think that's it. We've covered all kind of the macro stuff. Anything else you want to say, or are we done for the day?
I think that's good. I think that
all
really
right.
reflects
lots
the current lay of the land. Yep.
All right. Thank you so much. Have a great evening, everyone. And we'll be back here in 2 weeks to do a little macro to micro with just us, and we'll go from there. All right. Cheers.
Sounds
bye.
Good. Okay. Take care. Bye.